Welcome back to the Deep Dive. We are jumping straight into the latest fiscal intelligence. Tonight, we're breaking down the Q3 fiscal 26 results for a major cybersecurity platform for the quarter ending October 31st.
And, you know, the setup here was just intense. This report dropped after the bell, and the stock had already had this huge rally leading into the print.
For expectations were through the roof.
Exactly. Not just high, I mean, they were stratospheric. So the big question for us tonight is, did the operational story actually match that already rich valuation?
All right, let's get right into the hard numbers. Did they deliver?
Oh, they delivered. This was a clean, really decisive beat right across the board, showed some fantastic execution.
So what are we talking about, numbers-wise?
Well, if you look at profitability, non-GAAP earnings per share, that came in at 96 cents.
Okay, and the street was what, 94?
Around 94, yeah, so a comfortable beat there. And then revenue, same story. Yeah. Hit $1.23 billion, which sailed past even the high end of estimates. That's, you know, solid 22% year-over-year growth.
We should probably give the full picture, though. The GAAP number was still a loss, right?
It was, yeah. A GAAP net loss of 14 cents per share. They're still working through some significant accounting costs, but, you know, the market pretty much looks past that. It's all about the cash flow and the subscription story.
And speaking of that story, let's talk about the key metric, the one everyone was really laser focused on.
ARR, annual recurring revenue.
Of course.
Ending ARR hit $4.92 billion, which is up 23% year over year. But that's not the real headline. We need to pause on net new ARR.
Okay, this is where it gets really interesting.
This is it. Net new ARR hit a staggering $265 million.
Wow.
And let's just, you know, put that in perspective. That is a 73% acceleration year over year. Management even said it themselves, one of the strongest net new ARR quarters in the company's entire history.
So this isn't just taking a bit of market share. This is something else.
No, this suggests a massive rapid consolidation play is happening right now.
And a 73% acceleration in net new AR that tells an incredible story of recovery, doesn't it? I mean, we have to remember, this comes right after that major service incident back in July.
Right, the outage.
So these Q3 results seem to be saying that the recovery isn't just complete, it's actually accelerating past where they were before.
The operational strength is just undeniable, and the profitability metrics, I mean, they're setting records. Q3 had record free cash flow of $296 million.
Which translates to what as a margin?
A very, very healthy 24% FCF margin. And then non-GAAP subscription gross margin held strong at a best-in-class 81%.
Okay, hold on. Let's dig into that FCF number for a minute. $296 million is impressive, no doubt. But how much of that is real operational improvement versus, say, just timing? We know there were costs from that July incident.
That is a crucial point, and thanks for bringing it up. They had a $53 million cash headwind in Q3 just from payments related to that outage.
So they absorbed a $53 million hit and still put up a record number.
Exactly, which suggests the underlying operational leverage is actually much stronger than that headline number even shows. They are just incredibly efficient at converting revenue to cash.
And that efficiency is paired with a huge pile of cash.
A war chest. They're sitting on nearly $4.8 billion on the balance sheet. That's not just flexibility, that's dry powder for some very aggressive moves.
We'll definitely come back to that pile of cash later. But first, let's connect the operations to the product strategy, the land and expand motion.
Right, and the module adoption numbers are the clearest proof that it's working.
So what are those numbers?
49% of their subscription customers are now using 6 or more modules. And get this, almost a quarter, 24%, are on 8 or more.
So customers aren't just dipping their toes in, they're standardizing their entire security stack on this one platform.
They are. And the thing that's really greasing the wheels for that is the Falcon Flex model.
Which is designed to just cut through all the procurement red tape, right?
Right, precisely. And the market's response has been just phenomenal. Over $1.35 billion in ending ARR now comes from Flex customers.
Okay, and what was the growth on that?
It grew more than 200% year over year.
200%?
Yes. That kind of growth tells you that removing that bureaucratic friction is a massive competitive advantage. And they also said the number of accounts that reflexed, meaning they came back and spent even more than double just from last quarter. It's a self-fueling engine.
Okay, let's pivot a bit. Away from the numbers and more to the strategic narrative the CEO was pushing on the call. The big theme seemed to be AI and becoming the, quote, operating system of the SOC.
This is how they justify that premium valuation. They frame AI adoption as changing the entire game because of what they call the agentic workforce.
Okay, agentic workforce. That sounds a little like corporate jargon. Can you break that down for us? What does that actually mean for cybersecurity?
It's a great question because it does sound a bit buzzy, but the implications are real. Essentially, it means we're going to have more and more autonomous AI agents working alongside us.
Like AI tools automating tasks, accessing data on their own.
Exactly. And every single one of those AI agents becomes a new identity that needs to be protected, monitored, authorized. So their argument is that this new workforce just dramatically expands the attack surface, and their platform has to be both the armor and intelligence layer for every one of them.
That concept flows right into the SIEM market, which they're going after so aggressively.
And Falcon Next-Gen SIEM had a record net new ARR quarter because of it. There was a great example they gave of a large European bank.
I saw that. They renewed their big EDR deal, added a SIEM, and kicked Splunk out in a huge 8-figure expansion.
But what's so fascinating is how they're doing it. The secret sauce is the data they already have. Since they're already the EDR vendor, all that security data is already on their platform.
So they don't have to convince the customer to go through the pain of moving and storing all that data again.
Exactly. They can offer this incredibly disruptive pricing, and for the customer, it almost just becomes a licensing exercise to flip on the SIEM capabilities. It's nearly frictionless.
And they're doing the same thing in identity security, too.
They are. The identity business, especially Falcon Shield for SaaS apps, is really picking up steam. They told a story about a Fortune 500 logistics company. They deployed Falcon Shield and, in less than 30 minutes, found data being exfiltrated from their CRM.
30 minutes.
30 minutes to a 7-figure deal. I mean, that kind of speed to value is the best sales pitch you could ever ask for.
The strategic partnerships are just as huge.
Yeah.
I mean, the AWS announcement, that seems like a game changer.
Oh, it is. AWS selecting Falcon Next-Gen SIEM as the default SIEM for their customers right inside the AWS console. That's not just a small partnership.
No, that's putting your product directly in front of millions of potential users. It's a massive product-led growth engine.
It is. But don't sleep on the regulatory wins either. Their generative AI, Charlotte AI, got FedRAMP High authorization.
Which is the ticket to the big federal and regulated contracts.
The highest margin contracts, yeah. That one authorization just unlocked hundreds of millions in potential high-quality ARR that they couldn't even touch before.
The partnership that really caught my eye was the one with F5. Deploying the Falcon sensor on their big IP appliances. Why is that such a big deal?
Because, fundamentally, it's a physics problem they solved. These big iron infrastructure boxes, like F5's appliances that manage web traffic, they often just couldn't support a traditional security agent.
Too many processing constraints. They were basically blind spots on the network.
Total blind spots. And now they've figured out how to get their sensor onto hardware where it just wasn't possible before. They're shining a light into a really critical, previously dark corner of the network.
And they see it as a template for other appliance vendors.
Precisely. It's a huge innovative step to expand their total addressable market. And it's not just tech partnerships. EY is standardized as SIEM practice on Falcon. Kroll is ripping and replacing a competitor, moving almost 500,000 endpoints over.
These aren't just small wins. These are major organizations committing their entire practice to the platform.
And that's why the platform story really matters. It signals that the market is finally deciding that the pain of managing dozens of point products is worse than the pain of migrating to a single platform. We're seeing real systemic consolidation.
Which brings us to guidance. The forward outlook.
Which just reinforces all this confidence. For Q4, they guided revenue to between $1.29 and $1.3 billion, which is well ahead of where people were.
And they raised the full year guidance too.
They did. Raised full year FY26 revenue to about $4.8 billion. And non-GAAP EPS guidance was also raised, targeting up to $3.72 per share for the full year.
What about the longer term view, FY27?
So this is a key nuance for investors. They maintained their FY27 net new ARR growth expectation of at least 20%. Now, that might sound a bit low after a 73% quarter.
But it's 20% on a much, much bigger base.
Exactly. The absolute dollar amount of net new ARR they're projecting for next year is substantially larger. It reinforces that durable structural growth thesis.
So this brings us to the big investor paradox. The results were stellar. The guidance was great. So why didn't the stock just take off? It was pretty much flat in after-hours trading.
Yeah, the answer is really context and valuation. I mean, look at the chart. The stock was already up around 50% year to date. It was already priced for perfection.
It massively outperformed the S&P and the rest of the sector.
Dramatically. So this wasn't a surprise print. It was what we call a confirmational print. It proved the thesis was correct. It validated the rich valuation, but it just didn't provide enough of a positive shock to push it even higher.
The high valuation acted as a kind of gravity, holding it down despite the great news.
That's a perfect way to put it. When you're trading at these kinds of multiples, you need a true game-changing surprise to really move the needle. And the risks are still there. The high valuation itself and, some lingering headline risk from that July outage.
Okay, well, that's a great analysis. Let's move to our final segment, the one we call This Is Not Financial Advice. And as always, this is just for entertainment and strategic thought experiments. We have to remind you that all investments involve risk.
All right, so given that huge net new ARR beat, the crazy cash flow, and that war chest of almost $4.8 billion, this company is just screaming that they are ready to do a deal.
Their position.
A big one. Management talked a lot about observability and the ONU acquisition, which is all about data pipelines. They even said half of the Humio business they bought was already being used for observability. The signal is deafening.
So if M&A is clearly on the table, what's the outrageous but plausible trade idea?
The trade is this. You initiate a synthetic long position, maybe a long call spread, something expiring out in Q1 of FY27, and you're betting on a large synergistic M&A announcement.
Okay.
Here's the twist. The target is not another security company. We are betting on a strategic acquisition in the broader data fabric or observability space.
So you're predicting a surprise move outside of their core security market. Wouldn't Wall Street see that as a distraction?
That's the risk, but that's also where the opportunity is. The logic is that a big non-security data acquisition would completely unlock the platform's potential beyond the security operations center. It would position them as a comprehensive data player, not just a security vendor.
Leveraging that massive data pipeline they're building.
Absolutely. It would fulfill the CEO's vision of controlling the entire data backend and would force the market to completely re-rate the stock. It would be a huge surprise.
I love it. It's a bold thesis that leverages the balance sheet and the strategic direction they're already heading. That cash is definitely itching to be deployed.
It is. They are building a control plane for enterprise data. Security is just the first and most profitable app on top of it.
So to wrap this all up, this quarter basically confirmed that the whole post-outage story is in the rearview mirror. The pivot to agentic AI and platform consolidation is working incredibly well and supports that high-growth, high-margin story.
It absolutely does. And thinking about that innovative F5 partnership, lighting up those dark corners of the network, it leaves us with one final provocative thought.
Let's hear it.
Where else in the enterprise stack are the fastest growing tech vendors currently blind? Where else can they not run a traditional agent? And what company will be the next one to partner with the Falcon platform to solve that problem? The TAM expansion story here is far from over.